Last year, for the first time ever, the United States spent more just paying interest on its debt than it spent on its entire military. Not on soldiers, not on ships, on interest. $970 billion, roughly $30,000 every second. That one number is why the most powerful central bank on earth may be about to lose control. On July 29th, the Fed makes a decision, and by the end of this, you'll see the box it's trapped in, and the two ways out that both make it worse. Ground rule first. This channel doesn't give advice, and we won't tell you to buy or sell a thing. Not a bond, not the dollar, nothing. We map what's happening and the ways it could break. Let's map this one. Start with the size of the thing. The federal debt just crossed $39 trillion. But the number that traps the Fed isn't the total. It's how fast that debt reprices. Because Washington doesn't borrow for 30 years at a time. Roughly a third of the entire debt, about $10 trillion, comes due within the next 12 months and has to be refinanced at whatever interest rate the market demands that day. For a decade, that was a gift. The government kept rolling old debt into near-zero rates, and the average rate on the whole pile fell to about 1.5%. That era is over. Today, that average is back up to 3.4% and climbing. Every month, cheap old debt matures and gets replaced with expensive new debt. So here's the box. The Federal Reserve sets short-term interest rates to steer the economy, but the Treasury has to refinance a third of the national debt every year at those same rates. Which means every move the Fed makes to fight inflation now lands directly on the government's own credit card bill. That linkage is the trap. Now watch it close, from both sides at once. The first jaw is inflation, and it came back this year. After cooling to about 2.5% early in the year, prices re-accelerated all spring, over 4% by May, the hottest in 3 years. June cooled a little, mostly on cheaper gas, but look at what's underneath. Oil is climbing again, back near $80, with Brent already above it, on fresh trouble in the Strait of Hormuz, the exact choke point we mapped a few weeks ago. Tariffs are still feeding through the supply chain, and the Fed's own June projections now pencil in a rate hike before the year is out. 9 of its 18 policymakers see one. So the Fed can't simply declare victory and cut. Ease while inflation is running near 4%, and it risks pouring fuel on the fire and losing the one thing a central bank can never buy back: its credibility on inflation. That's jaw one, holding it up. Now the other jaw, because the economy is flashing the opposite signal too. Hiring just fell off a cliff. The June jobs report showed only 57,000 new jobs, down from 129,000 the month before. Normally, that's the cue. Growth is cooling, so cut rates and cushion the landing. Except here's where the trap gets clever. The Fed cutting might not lower the rates that actually matter. This is the part most coverage skips. The Fed only directly controls short-term rates, but the government's real financing cost and your mortgage track the 10-year Treasury, and those two do not have to move together. Look at right now. Even as traders started pricing rate cuts, the 10-year yield backed up to about 4.6%. Why? The term premium, the extra yield investors demand to lend to Washington for a full decade, has turned sharply positive, worth around 0.8 of a percentage point now and climbing. Investors see trillions in new borrowing every year, and they want to be paid more for the risk. So picture the real nightmare for a central banker. The Fed cuts, and the bond market ignores it. Long rates stay high, or rise anyway. The Fed eases, and the economy doesn't get relief, and the government's borrowing costs don't fall. That isn't a rate cut. That's a central bank discovering the bond market is now in charge. Economists have a name for it: fiscal dominance. Now, let's be fair and steelman the other side, because there's a real case this is overblown. The United States borrows in its own currency. It can always pay. Demand for treasuries is still deep. Every auction clears. And nominal growth plus a little inflation can quietly shrink a debt over time. It's how America worked down its Second World War debt. All true. This isn't a bomb with a lit fuse. It's a slow tightening. Interest already eats about 19 cents of every tax dollar the government collects, and that share climbs each year. The danger was never a sudden explosion. It's that the trap removes the Fed's freedom to maneuver, right when it may need it most. So what does all this mean for July 29th? Here's our base case, the most likely read, not a prediction. On July 29th, the Fed most likely holds, but only just. After June's softer inflation print, the odds lean toward no change. Even so, markets put better than a third of the odds on a hike, a number that swung from almost nothing toward 50% in a single week when oil spiked. So the Fed holds, talks tough, and buys time. The trap doesn't spring, it tightens quietly. Cheap debt keeps rolling into expensive debt. The interest bill grinds higher in the background, and the Fed guards its optionality by refusing to commit either way. Higher for longer, hoping the economy threads the needle before the math forces its hand. That's the center of the road. Now the two ways off it. The first flip is hawkish. If inflation reignites, oil breaks higher through Hormuz, tariffs bite harder, the next CPI runs hot, the Fed gets forced to hike into the fall. Its own dot plot already leans that way. And here's why that's not just another rate move. With $10 trillion refinancing this year, every extra percentage point the Fed adds flows straight on to the national interest bill within months. Tens of billions of dollars compounding. Fighting inflation the only way it knows how would make the debt spiral worse. The Fed would be choosing between the economy's health and the government's solvency. That's the flip where the trap actually bites. The second flip is quieter and stranger. Growth cracks, the Fed cuts, and long rates rise anyway. The term premium keeps climbing, foreign buyers keep stepping back, and the market demands more to fund the deficit no matter what the Fed does. In that world, the Fed's rate cuts simply stop working. The lever that fixed every crisis for 40 years just stops responding. Mortgages don't fall, the government's costs don't fall, and everyone learns at the same moment that the bond market, not the Fed, now sets the real price of money. Same meeting, opposite failure. And it hinges on one thing: how the 10-year behaves the instant the Fed blinks. So, we don't predict. We watch three tells. 1. July 29th itself. Not just hold or hike, listen for whether Chair Warsh mentions the deficit, the term premium, or the long end at all. If he does, the Fed is admitting the constraint out loud for the first time. 2. The 10-year's reaction to any hint of easing. If the Fed signals a cut and the 10-year falls, the old playbook still works. If it rises, flip 2 is already starting, and that's the tell that matters most. 3. The slow one, running in the background, the average interest rate on the debt. It's 3.4% and climbing. Every tick higher is the trap closing another notch. No headline required. Watch those three, and you'll see which way this breaks before the market gets around to naming it. The Federal Reserve spent 40 years as the most powerful force in markets, but it built that power in an era of cheap debt, and that era is gone. More on interest than defense. A third of the debt repricing every year. A bond market starting to set its own terms. Whatever the Fed decides on July 29th, the box it's deciding inside just got smaller. And now you can see the walls. Not financial advice. Scenarios, not recommendations. If you want the clear-eyed version of what's actually moving markets, the base case, and what flips it, subscribe. New read every week. Crosswind Economics.